Thank you for joining me. I'm Alex, and I want to talk about the New York Times Corporation didn't fit. And what they do is news. It used to be a big newspaper, now it's obviously mostly online. Current price $46.72, which gives them a market cap of $7.8 billion. Dividend yield just over 0.5%, which isn't that great. 24% payout ratio is also not that great for that low of a dividend yield. Revenue $1.8 billion, slightly up. Earnings $140 million, even slightly up. And currently a PE of 50 with forward PE of 42, which is also not great. And in case you're wondering, payout ratio and PE kind of related, or rather dividend yield and payout ratio and PE. Total assets $2.1 billion, total liabilities $915 million, both of that down, which is something you don't see a lot. Total stockholders equity $1.2 billion, which is slightly up. Obviously a pretty nice balance sheet. I would almost call that perfect. The only thing to note here is that the PE is slightly high. Risk factors, print is dead, is kind of the main risk factor here. I think that the New York Times itself is doing pretty well, all things considered. So I don't think there's any new risk factors here or coming up. So overall, not really much to worry about in terms of risk factors. So obviously for a growth investor, there's not really enough growth here. For a dividend investor, there's not really enough dividend here. And for a value investor, there's not really enough value. The PE is too high. The revenue growth is too low. And the balance sheet being nice doesn't really make up for that. So overall, wouldn't recommend the stock, not because the company isn't great, it's just kind of overvalued in my opinion. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.